Hey guys, Joe Frank here, market analyst for YouTrading, and in today's video we're going to be taking a quick look across markets, talking about the key themes that are in play at the moment and how things could shake up for the remainder of the week. So let's start off by looking at the dollar index, which is currently in the process of slipping below its 50-day moving average. Certainly does seem to be trending to the downside now, which, to be honest, for me, is not too much of a surprise given the aggressive moves lower that we've seen recently in like the 2-year yield, which is still under 4% today, actually hit its lowest level since September earlier in the day, having been above 5% literally earlier this month. 10-year yield also substantially lower as well, had been above 4, now above 3.5%. All a reflection of less bets that the Fed isn't going to do much more tightening or potentially might even be cutting interest rates soon, and pessimism about US economic growth as the bank crisis continues to rumble in the background. In terms of the latest news we've had on that, it was Credit Suisse being bought out by UBS over the weekend. But you've still got troubles bubbling under the surface in the US banking sector, with First Republic shares still doing poorly amid concerns about that bank, despite the fact that they had a rescue deal last year. And all eyes are on the Fed, really. We've got the Fed meeting coming up on Wednesday. We've also got the SNB and the Bank of England. Now, all of these banks are expected to do rate hikes. Like the SNB is actually expected to do a 50 basis point rate hike. The other two, the Fed and the BOE, expected to do 25 basis point rate hikes. But a lot of people are worried that, if all these banks, you're getting the first dominoes falling potentially of a cascading collapse of a lot of banks, and the beginnings of a financial crisis. Do you really want to be hiking into that? That's the concerns a lot of people have. A lot of people thinking that actually really what the central banks should be doing now is getting ahead of the crisis by cutting interest rates. Obviously, though, the problem is inflation remains way above the Fed's target, the Bank of England's target. I think even in Switzerland it's a little bit above their target as well, although inflation's generally less of an issue over there. But for now, the dollar index coming under pressure as a result of those dovish Fed bets, because remember, the Fed was the most hawkish of the major central banks. So when everybody pivots dovish, even if the Bank of England is going to pivot a little bit more dovish as well this week in the S&B, although the S&B is going to do a 50 basis point rate hike, so that's not really pivoting dovish, or they're expected to do that. The Fed was the most hawkish, so the dollar's almost kind of got like the most to lose there. In terms of stocks, struggling, like just grappling really in this key support area with the 2022 downtrend, the 200-day moving average. Is the bear market over? Was this break above the 2022 downtrend a signal of a gradual sort of recovery in 2023? Are we potentially going to be heading lower towards the lows from the end of December, which I've been talking about for some time, and the lows from last October? I think risks are tilted to the downside. I got to say, guys, like this banking crisis, I think is going to be keeping the bulls at bay for now. I don't think many people are going to want to be chasing the S&P 500 above 4,000, unless authorities really get things under control. But you've got a massively inverted yield curve, trouble in the banking sector. Before this began, people were still expecting a recession later this year in the US anyway. I mean, I think you got to think that you never want to say anything with certainty, but it's very likely that we're going to see a US recession. That's bad for earnings. And typically, we talked about this in a video a couple of weeks ago, but typically stocks don't actually bottom. They never normally historically bottom before the Fed starts cutting interest rates. They historically bottom when the Fed is well into its interest rate hiking cycle. So say, the bank crisis does send the US economy into recession in the second half of this year, and the Fed starts cutting interest rates, it might take until 2024 before we see a bottom. So yeah, to be honest, I'm a little bit pessimistic, and I'm expecting these downside targets could well be hit. Unless authorities really get things under control. And, I mean, if the Fed surprised us with a 25 basis point rate cut this week, uh, that would be a bullish sign potentially that they're really trying to get ahead of this crisis. Unfortunately, that's not what markets are pricing. In fact, let's actually just have a quick look at what the Fed, what money market probabilities are suggesting as a potential. So nearly 70% chance of a 25 basis point rate hike, pretty much. That's what the market's pricing in right now. Pretty much nobody pricing, well, no likelihood at all priced of a rate cut. So yeah, and the Fed doesn't like to surprise markets too much, by the way, because they see that as a failure of their sort of communication and forward guidance. So it doesn't look like we're going to get that 25 basis point rate hike. So that's probably going to keep things on the defensive for now. Let's talk about the assets which are doing well. Gold hovering close to recent highs. Actually, briefly went above 2,000 earlier in the session for the first time since. Did it go above 2,000 that day? No, the first time since last March. So in over a year, above 2,000. Bitcoin also has been doing well recently. It's hovering 27,600 right now. Just waiting for the next big push. Now, gold and Bitcoin, both viewed as safe haven alternatives when the traditional central bank, well, fiat currency, central bank centered fractional reserve banking system that we've got, which is the traditional financial system that we've had since the 1970s. When doubts emerge about the stability of this system, gold, which was historically at the center of the monetary system, does well because it's an alternative. And Bitcoin appears to be doing well as well because it's a new alternative, digital gold, as people like to refer to it. So, if these jitters continue worsening, both of these asset classes could continue making up some ground. I mean, actually, before we look at gold again, Bitcoin could break higher towards 30K, push towards this next resistance area in the 32 to 33K area. Gold could break above this high from last April and push towards the all-time high, which was nearly hit last March, but actually was printed back in 2020. When was that? August 2020? Yeah. Could push up to that area. Because remember, for stocks, things could go. I mean, I think risk is still tilted to the downside, but things could go either way. Like if the Fed really, really turns dovish now, starts cutting interest rates, then that could lift stocks. But if not, then concerns about the financial stability are going to still be there, weighing on stocks and all that kind of stuff. But with gold and Bitcoin, concerns about financial stability are positive for both of them. And if the Fed turns dovish, yes, you'll have less concerns about financial stability, but gold and Bitcoin and cryptocurrencies in general like it when financial conditions ease. So it's almost like everything's pointing in the same direction for both of these asset classes right now. Anyway, oil, WTI, this is front month futures, looks like it's slipping towards this area of support that I have marked up here, the 62, 61 area, on concerns about a recession in the US and other major economies, on a banking crisis. Basically, this is a demand pessimism driven move. And just quickly, in terms of a couple of other things that we got on the calendar this week, Lagarde speaking, or Lagarde already spoke actually. Canadian CPI, that'd be interesting. Lagarde speaking again. UK CPI, Lagarde again. Oh my God, Lagarde every day. SMB, BOE, obviously Fed as well. And then we got these flash PMIs, but really, this data is just not the focus right now. I mean, obviously, yes, the inflation data, UK, Canada, it'd be nice to be seeing it moving in the right direction to mean that the central banks could potentially have more room to ease if they need to protect financial stability. And yes, it would be good to see strong flash services and manufacturing data out of these major Eurozone and economies and out of the US as well. Because that would suggest that the economy is sort of robust heading into what could potentially be the start of a financial crisis. But the main thing here really is banks and what's happening in the financial sector. Like, for example, loads of people lost money on their debt investments into Credit Suisse, and a lot of people had massive, massive drawdowns on their equity investments in Credit Suisse. Is that going to start causing some contagion across Europe and other parts of the world? We're going to have to wait and see. But yes, that's definitely the main theme of the week. I'll stop rambling on. Guys, hope you all enjoyed the video. Hope you all found it informative, and I'll see you all in the next one.